half of the bank's assets that had been reported as healthy, performing loans, didn't exist. They'd been sold over the years by Keystone to cover the costs of their unprofitable business. It was $515 million that was missing.
Welcome to Banking Bad, where we look at past financial crises, the lessons learned, and what we might be doing to prepare ourselves for the next crisis. We can't know for sure if or when another crisis might occur. We don't know whether some of the leading markers of our current age, the advent of cryptocurrency, private lending, fintech, social media, or something else might serve as the catalyst to trigger a crisis. We don't know whether any specific sector problem could spill over to the regulated banking sector. But what we do know is that the seeds for the next crisis are very likely being planted today. History may not repeat itself, but it very often rhymes. The people you hear from on Banking Bad have a unique vantage point. They're not Monday morning quarterbacks making observations about what they think might have occurred. When banks went bad, our guests were actually leading the teams charged with closing the banks. They were on the front lines, meeting with the people whose lives were upended. They were the ones working around the clock, in the trenches to uncover problems and implement solutions. They would tell us what they uncovered in their work, what they learned when they unraveled the difficult circumstances that caused banks to fail, and how those lessons may or may not apply in today's rapidly changing world. Their recommendations will be directed towards the legislators who create the laws, the regulators who make critical decisions based on those laws, and to the financial sector and general public who must live with the results. You may not always agree with us. The issues are complex and our guests may not always agree with each other, but we strongly hope our views will provide valuable context to the decision-making process. My name is Tom Weiss. I'll be one of your three hosts for this series, along with David Walker and John Bavenzi. I was formerly Senior Vice President at the Canada Deposit Insurance Corporation and an experienced banker. David, an economist, was most recently the Secretary General of the International Association of Deposit Insurers in Basel, Switzerland, and before that, a Managing Director at CDIC. John has over 40 years' experience in banking. A good portion of that was at the FDIC, where he served in senior executive roles, including Deputy to the Chairman and Chief Operating Officer during both the savings and loan crisis and the 2008 financial crisis. John also served as Chief Executive Officer at IndyMac Bank during the financial crisis of 2008. He was a partner at Oliver Wyman and co-founder of the Bavenzi Group, a financial consulting firm.
And hi, I'm David Walker. In this first podcast, our colleague, John Bavenzi, will examine the rise and fall of Keystone National Bank, a bank that failed over 25 years ago but still has important lessons for us today. As director of the FDIC's Division of Resolutions and Receiverships at that time, John had a first-hand view of the developments at Keystone, and will revisit that chapter in his career and talk about some of the colorful characters and financial shenanigans that led to the bank's demise. Along the way, perhaps we will learn a thing or two about how banks can get into trouble and cause considerable damage, both locally and potentially to the national economy as well. Look forward to digging into this with John.
Well, thanks, David. I'm looking forward to the conversation as well. Keystone National Bank is sort of a textbook case of everything not to do if you want to run a successful bank. They had greed, unbridled ambition. It was horrible mismanagement. They bullied their own staff and tried to bully the regulators. And all of it led to a massive fraud and cover-up. And, when the game was finally up at the end, they quite literally hid, or in this case, buried the evidence.
Well, John, can you set the stage for the story? What was the background behind Keystone Bank, and what should we know about it?
So let me start with the location. Keystone, West Virginia. It's up in the mountains in West Virginia, fairly remote, not near any airports or anything. It was a big coal mining town, but its peak days, were back in the 30s and 40s. So the coal mining boom had long since passed. At that time, they were booming and it was a pretty wild town. But now It's an elderly, small population, 600 people, very poor. And many of the residents are living off their Social Security checks and disability payments, since black lung disease was pretty common in the coal mining town. That is a community where all this took place. And there was only one small bank in town. It was founded in 1904. It had survived the Great Depression, and it had a motto up on the wall, said, "Time tried, panic tested," to test its ability to survive through a crisis. But it was small. By the late 1970s, the bank only had $17 million in total assets. So you really couldn't have found a more unnoteworthy bank or a more remote location, which apparently made it a great place to commit a crime, since no one would expect it.
Okay, well, that's an interesting locale and backstory, John. How did this somewhat forgotten area serve as the incubator for an almost textbook story about what can go wrong in the banking world?
So the central character in this story was a man named Knox McConnell. He grew up in Pittsburgh, very ambitious, thought about becoming a boxer. In fact, his mentor and close friend, who was 10 years older, was Billy Conn, very famous boxer, light heavyweight champion of the world. His claim to fame was fighting Joe Louis and almost becoming the heavyweight champion of the world. And Knox became very close to Billy Conn. He actually wrote a book about Conn titled The Boxer and the Banker. And Billy Conn gave career advice to McConnell. He said, "If I were you, kid, I would be a banker. They go to work at 9 a.m., they leave at 2 p.m., and all day long they sit and look at the most beautiful stuff in the world, money." You know, that quote from Billy Conn's a little reminiscent of Willie Sutton, who, when asked, "Why did you become a bank robber?" he said, "That's because that's where the money was." McConnell did become a banker. He got the job at Keystone as CEO in 1977. And he was one of these guys that just wanted complete control over everything. And he had some interesting quirks. He had a virtually all-women workforce, which became known as Knox's Foxes. And, you know, coincidentally, a number of years later, 1989, I became deputy to the chairman. And I didn't know Knox McConnell, and I never met him in my life, but he sent me a letter. I'm going to just read part of it to you. "Although we do not know each other, I saw where you were recently promoted. I have the highest regard for the FDIC. President Bush happens to be a close friend of mine. I was finance chairman for the state of West Virginia for George Bush president. And in my correspondence with him, I informed him, of all the regulatory agencies, I feel that the FDIC and the Federal Reserve are the two premier agencies. I have very little regard for the rest of the regulatory bodies that govern the financial communities. So when I saw your recent promotion, I felt compelled to send you our famous passport. If you carry this at all times," and he actually sent me, he cut out my picture from the American banker when I got the job, put it on the passport, called it a passport, and said, "I have free pass to the county of McDowell, and wish me the best of luck." So you get a sense of the kind of character that Knox McConnell was.
Well, how did the bank get started down the path that would eventually lead to its downfall?
McConnell wanted to make his mark on a national level. He wasn't really satisfied just being, a big shot in Keystone, West Virginia. And he sort of stumbled upon the idea of buying subprime loans, and in this case, home improvement loans. And he bought them from other banks starting in 1992. Then he would repackage the loans and sell them as securitizations. The bank would keep the residual pieces, which are the riskiest parts of the securitization, since they're the first ones to take losses when some of the loans go bad, and sold the rest. He didn't really understand the business, but he saw it as an easy way to make some money. There wasn't enough money in Keystone, West Virginia to fund such a business. So he started attracting money nationally through brokers. And he did this by paying the highest deposit interest rates in the country. So he was able to attract a lot of money to his bank. And this did the trick. The bank grew rapidly, starting with only that 17 million. By the time it ended, the bank had $1.1 billion in book value, even after packaging and selling most of what it had purchased. So obviously, this kind of rapid growth is a real red flag to regulators, since generally it means you're growing faster than you can keep up with your management capabilities. Over the next 5 years, the bank did 19 securitizations, and there were 3 years in a row where the American Banker, the publication, named Keystone as one of the best performing banks in the country. So it would take a while before people would figure out that this really wasn't the case. And so Knox was very progressive in some ways. Securitization wasn't a very big deal at the time, and he jumped into it. In other ways, he was pretty old-fashioned. The bank didn't even have an ATM. And as Knox explained, he said, well, this is an ATM country. If one of those things broke, someone would take out a gun and shoot it. Knox was also very charitable. He gave generously to the community, and this poor town started becoming revitalized. Knox and his Foxes bought up a lot of the local businesses and helped really stimulate the economy. Of course, as it turned out, his generosity was based upon giving away other people's money.
What was a significant turning point in this story?
Well, Knox died in 1997, 2 years before the bank was closed. Billie Jean Cherry took over as bank president. She would later become the mayor of Keystone and was viewed by the regulators as something of a figurehead president. Terry Church was really the banker, and she took over, the management of the securitization program. Interestingly, the two women continued the same contentious relationship with the regulators that Knox had, and in fact, things only got worse under their leadership.
Well, in your book, Inside the FDIC, you mentioned you didn't think McConnell had intended to perpetrate a fraud. Well, how did he get into a situation where fraud became the key operational element that really kept them in business for much longer than they should have?
They were ill-equipped to manage such an operation. They really didn't understand it. And there was little margin for error. When you're raising the highest cost funding in the country, you've got to make more money than otherwise. And with subprime loans, a lot of them go bad, and, there are losses. So if it's not well managed, it's easy to start losing money. And that's what they were doing. When the loans started going bad, the buyers of the securitizations began demanding repayment because they saw that everything had been poorly documented, badly underwritten. And as the banks started to repay them, they started sliding into insolvency. So eventually, McConnell began to falsify the bank's records in order to cover up his mistakes. Over the years, the fraud just grew larger and larger and became harder to conceal. And after his death, Cherry and Church, who were willing accomplices all along, continued to perpetuate the fraud.
Whoa, that's amazing. John, can you speak about the oversight of the bank? What were the auditors and regulators doing at this time?
Yeah, the Office of the Comptroller of the Currency was the bank's primary supervisor. And when I read part of Knox's letter, he didn't mention the OCC as one of the regulators that he thought much of, and that's because they were supervising the bank. They were trying to figure out what was going on. Knox and then later Church and Cherry would try to slow the examiners down as much as they could. Bank supervision sort of works in a pendulum fashion. You get periods where there's very strong regulation, but eventually over time it weakens until there's some sort of financial crisis, and then it gets stronger again. This period of time was one where it was a deregulatory period. It was loosening supervisory, standards. And one of the ways this was done was that the OCC examiners only had a certain amount of time in any given bank. And so Knox would just slow them down till it was time for them to leave, and they couldn't really figure out the fraud that was going on. And Knox also made the examiners feel very threatened. And at one point, they actually called in the U.S. Marshals to have protection. Now, the FDIC wasn't the supervisor, but it was the deposit insurer. And as deposit insurer, the FDIC pays the cost of bank failures. And the FDIC's examiners were questioning the value of the bank's residual portfolio. As mentioned, this is the riskiest part of the securitization. It's very hard to value it since you're not really sure how many of the loans are going to go bad. But the FDIC felt that the bank was dramatically overstating the value of its residual portfolio, and it asked the OCC to participate in the next bank examination. Well, the OCC just flatly refused, calling the FDIC's participation unnecessarily burdensome. Again, a sign of the times that the emphasis was much more on not burdening the bank rather than getting to the bottom of what the situation may be. And the OCC and the FDIC had a fairly rough relationship in this regard, since FDIC had continued to pay the costs of bank failures and wanted to get into examined banks, but the other regulators wouldn't let it. Now, eventually, enough of these situations came up where losses grew much larger than they had to be, where the FDIC was able to get into banks. But in this case, they were held off as long as possible until 1999, when they were finally able to participate in an examination with the OCC. And the OCC at the time was also getting very suspicious. So this was sort of a crack examination team that went in and determined that the residual securities had been overvalued by the bank by so much that the bank was actually insolvent. And so in that case, the FDIC would start planning for how to close a bank. But the residual securities were only half of the bank's assets. The other half had always appeared to be in good shape, and they'd been managed for the bank by an outside servicer. But the OCC had never gone directly to the servicer to determine the value of those other loans. They'd always just received the records from the bank itself, which made it look like all the loans were performing well. This time, given everything else, the examiners insisted on hearing directly from the third-party servicer. And once they did, the game ended in a fairly dramatic fashion. The examiners realized that the bank didn't even own loans. Half of the bank's assets that had been reported as healthy, performing loans, didn't exist. They'd been sold over the years by Keystone to cover the costs of their unprofitable business. It was $515 million that was missing.
John, we'll get back to the concept of the pendulum nature of supervision you referred to, but first, what were some of the crazy things the bank did in the final stages after they knew the gig was up?
So, with such massive amount of fraud, there had to be an investigation, as there always is when a bank fails. And as is typical, the regulator, the OCC, ordered the bank to preserve all of its records. But Church and Cherry, weren't yet ready to give up. When a bank employee asked Terry Church if they should burn the records, she said there were too many to burn without attracting attention. So instead, she ordered the staff to bury the records in her backyard. They went out and dug a hole 100 feet long, 30 feet wide, and 10 feet deep. They drove trucks up to the bank, opened the window, threw the records out of the window into the truck, and filling 4 truckloads eventually, buried them all in Terry Church's backyard. And when they were done, they planted grass seed over it to try to make it look inconspicuous.
Well, John, how did they end up finding those records?
Well, I think they probably would have been found eventually, but the truck driver who buried the records never got paid. and, by the bank. And when the FDIC came in, they run a process of paying people for money they're owed, when the FDIC wants them to keep working. And so the truck driver came into the FDIC's claim agent and said, I want to get paid for, burying the records. And the person said, what?
Can you tell us what happened after the failure and the FDIC came in as receiver? What was the actual event or tripwire that forced the closure of the bank? And how did the regulators, I guess OCC and FDIC in this case, plan and orchestrate the actual point of closure?
So once the examiners uncovered the fraud, word got out into the community and there was a run on the bank. Lines formed, merchants stopped honoring the bank's checks. This left no time for the FDIC to plan an orderly closing because the bank had to be closed immediately. It was just running out of cash and people were trying to get their money back. And the FDIC staff was all over the country, some in Dallas, some in D.C., and there are no easy flights out to Keystone, West Virginia. So in Dallas, they actually chartered a plane and the closing staff flew in the middle of the night and landed a number of miles away. They had to rent cars to get out to Keystone, but there's not really any room in Keystone for that many people closing a bank. So every day they drive 40 miles back and forth as they were handling the bank closing. The communication in the mountains was very bad. All the people in the town and elsewhere were trying to figure out what was going on. So, bank had a few phones, but hundreds of calls were coming in and the staff couldn't keep up with it. So they decided to hold a town hall meeting to explain to everybody in the community what was happening and why, and let them know that any of their insured deposits were safe. Ricky McCullough, who was our ombudsman at the FDIC, and David Barr, who was in the press office, held the town hall meeting and started to explain what was going on. And virtually all of the town's residents, 450 people or so, showed up and at this school gymnasium to hear what's going on. And it was really hot that day. I mean, it was over 90 degrees. There were plainclothes U.S. Marshals in the audience in case things got out of hand. So at first it was a little contentious and very hot. And then someone in the audience offered David and Ricky, bottles of cold water. And, they thanked them. And all of a sudden things became much more relaxed. The people of the town, despite the stories of threats, they were very good people who had been through a lot of hardship and just wanted to know if they were getting their money. And so the first order of business was handling their Social Security checks and their disability checks because the bank was closed on September 1st, 1999. Social Security and disability checks normally come in on the first of the month. And now the bank's closed. Where were those checks going to go and how were they going to get them? So that day, the FDIC staff arranged for the checks to come in to the closest bank to Keystone, which was a distance away, but still manageable. So everybody that needed those checks for day-to-day living, were able to get them. The second order of business was getting people their insured deposits. That wasn't really simple in this case because of the way the bank kept the records, but that too was worked out so that this other bank, the FDIC, transferred money to the other bank to pay people their insured deposits. So most of that worked out well. However, there were a number of hardship cases. The people in the town had trusted Knox and Cherry and Church. Many lost money. Some people had uninsured deposits in the bank. Others, including bank employees, had purchased stock in the bank and the stock was wiped out. It was worthless. They had all trusted the bank and the FDIC agents delivered the news to them that they weren't going to get all their money back. One person actually committed suicide, when he found out that he'd been misled and lost all his money. So there were people in the town who lost a good amount. And as you might imagine, the artificial stimulus to the town that Knox and his followers had created disappeared. The town fell back into poverty, and it was really a sad story overall, all caused by these folks with outsized ambition and willing to perpetuate fraud at the expense of the town people and the FDIC. I mean, the FDIC it cost $532 million, an enormous amount for a bank that size, all of which ultimately is paid by other banks and bank customers. After the bank was closed, Billie Jean Cherry claimed that the government was only after her and Terry Church because they weren't Ivy Leaguers. And, during a town council meeting, Cherry made a fist and said, anyone tried to remove me from my job as mayor, I'll give them some knuckle pudding. Nevertheless, she lost her job as mayor. She was sentenced to 16 years in prison. Her sentence wasn't for the misdeeds at the bank because she was more of the figurehead, but her sentence was for stealing money from Knox. Cherry had a 30-year romantic relationship with McConnell, who was a lifelong bachelor. But when Knox died, he left all his money to his alma mater, Waynesburg College, rather than to Cherry. She felt entitled to the money, so she took it. In fact, Cherry and Church forged Knox's will and began taking his money as soon as he died. So that was the crime to put her in prison. And Terry Church was sentenced to 27 years on bank fraud charges, and she was really the one running the bank after Knox passed away. 4 other employees received prison terms, and the auditor, Grant Thornton, ended up paying the FDIC $20 million in fines since it, over the years, had missed the fact that half of the bank's assets were missing. And the law firm also got fined $20 million for its work with the bank.
Wow, what a story. And what reforms were put in place after all of this?
So capital standards were raised for some subprime loans, which solved the immediate problem, but it actually inadvertently set the stage for the 2008 financial crisis. I think it was Alan Greenspan who said that actions taken to resolve one crisis often sow the seeds for the next. And the scale of the fraud at Keystone had obscured the bigger risk here, which was the growth of subprime lending and the losses associated with it. And prior to the 1990s, most subprime lending activity took place outside of the banking system. By the mid to late 1990s, bank holding companies began to acquire subprime lending companies. The FDIC had advocated for a higher capital standard for subprime loans since they had such a high default rate, but was only partially successful due to resistance, as expected from the banking industry, but also unexpectedly from the other bank regulatory agencies who were still in their deregulatory, reduced supervision mode. So a compromise was reached. Banks were required to hold enough extra capital to cover 100% loss on residual portfolios, and they were raised for banks that had a subprime program, which really meant that they had a substantial amount of subprime loans. The unintended and unnoticed consequence was that banks simply shifted their subprime lending activity to non-bank affiliates, where the capital requirements remained unchanged. And this is what set the stage for the 2008 financial crisis, since that's where a lot of the losses in the big financial institutions occurred. And it took a while for folks to realize, since the banks looked clean, they had subsidiaries that weren't, that had absorbed these high risks. And it's something we'll see often in this series is money flows to where there's the least resistance. And so you have to be careful of the unintended consequences if you fix one problem, but set the stage for the money to go elsewhere and create a different one.
Well, to conclude, it's always difficult to summarize a complex situation that evolved over a period of years in a few sound bites. But in your view, what are the big issues that contributed to this financial calamity? And, even though Keystone was in a different era, are there any useful lessons from the story that we can apply, in our own time, in our own discussions, say around, fintechs, crypto, stable coins, what are the implications for all of this?
One is, if you see rapid growth, it's a key red flag. We see it as regulators, we see it time and time again that, institutions that grow faster than their ability to manage that growth can well get into big trouble. Happened with Keystone, a heck with many others, and even as recently as 2023, if you take a look at Silicon Valley Bank, that was a good part of its problem. So regulators can't ignore rapid growth. They've got to pay attention to that and not keep making the same mistakes. Another point is, we saw the supervisory pendulum. It keeps swinging back and forth with tough and easy regulation. The banking industry was clearly overregulated under the Biden administration. The banks couldn't do much new or innovative. If you overregulate, you stifle growth, innovation, and again, you inadvertently create an incentive for activities to move outside of the banking system. But now the pendulum under the Trump administration is swinging back the other way toward much reduced regulation. We don't know yet how far that's going to swing, but there needs to be a happy midpoint where innovation and sound government regulation can coexist without sowing the seeds for the next crisis. So that's a second point, I think. Some others that maybe also need to be paid attention to. When you have a leadership in a bank that's dominant, intimidating, there's a lack of checks and balances within the bank that can lead to problems. When you see bankers having a confrontational relationship with the regulators, it should make you think, what are they trying to hide? Clearly, bank supervisors need access to banks' third-party servicers. If here we saw that without that access, the bank simply forged the records and perpetuated the fraud. And we see that it's important for bank regulators to work closely together. They should be sharing information, and there's unnecessary tension between the regulators all the time, particularly between supervisors and deposit insurers. Supervisors don't want to be blamed if things go bad and maybe give the bank more time than they should in terms of healing itself. And the deposit insurer pays the cost, and they want to make sure that they solve a problem before it creates too much trouble and cost to the community. So there needs to be a balance in them working together and sharing information, not fighting with each other as we saw in Keystone. So those are some. I'm sure there are plenty more that can come out of this, but those seem to be important ones to me.
Thank you, John. That was a fascinating discussion. The lessons you highlight are really fundamentally sound banking and regulatory practice issues, but as this story highlights, over time, circumstances can emerge that mask poor judgment, make it difficult to detect problems in the system, and can lead to destabilizing events such as that which we saw at Keystone National Bank. My co-host and I have a regulatory background, and we can tell you from firsthand experience that after every crisis, the regulatory response is to take steps to ensure that the underlying cause of that crisis will never occur again. But, unfortunately, financial history reveals a different lesson. It suggests that the system can fail again, just not likely in the same way. This definitely does not mean that solutions developed to deal with past problems were not needed. Far from it. I think what it suggests is that we need to be vigilant to make sure that the solutions implemented to deal with past problems remain useful in our current environment. Perhaps there's universal truth in Mark Twain's contention about history as applied to the financial sector. Financial crises are never repeated, but they do often rhyme. I'm sure there are many people out there with at least as many interesting stories in their backgrounds as we have, and for those folks, many of you I'm sure, the world can only benefit from being exposed to the hard-won lessons of your past. Please reach out to us. We'd love to hear from you. In the meantime, we look forward to our next episode, where we revisit our regulatory and financial backgrounds to capture some rhyming verse that might provide useful perspective on our current condition. Thank you for listening.